right, welcome back. You're with us here on Tips for Tomorrow. We've got Mohit Mirchandani, head of equity at Taurus Mutual Fund, with us to talk more about what he expects as we get into trade tomorrow and over the next couple of days. Mohit, thanks for being with us here on the show. Prashant this side. Let's start with the market per se. May, how do you think it's going to pan out? We've got a cut today. You think it probably deepens a little bit from here, or the constant theme of buying the dips will probably come back tomorrow, if not tomorrow, very quickly?
I think buying the dips is still the mantra, in my opinion. The difference is whether you buy tomorrow or you buy 4 days later at lower levels. I think that's just to be judged on a stock by stock basis, because some stocks will correct a little more than others. They'll get to relatively more attractive valuations quicker than maybe the broader market. So rather than look at a nifty level at which point you go in and buy, keep an eye out on individual stocks that you like, and when you see a good level for them, go ahead and buy them, irrespective of the nifty level.
What have you been doing, Mohit, with the market over the last couple of odd days?
We've actually been stock picking. That's been the theme for the last 7, 8, 10 months now. Because remember, the Nifty post, let's say around May, June last year, was about 4,800. Today we are 5,200 or 5,300. So really, in almost a year, the markets have gone nowhere. But there are a lot of names that have, in the meantime, doubled and tripled in the same period. So we believe that taking a call in the market for most of the last year has actually been a futile exercise. And we think that same theme will continue for a good part of this year, until such time valuations between mid caps and large caps narrow down a little bit, and until such time the market begins to look at FY12 earnings, at which point you're looking at 1250 and 1300. And then the markets don't look so expensive if you're looking at FY12 earnings. But we're only in May of this year. So I think it's too early to look at FY12. That will probably come into play towards the end of the year. So we might, from now till the end of the year, at the market level, we might just bide time till we wait for earnings to catch up. And we wait for the European jitters to cool off. But in the meantime, there are a lot of opportunities at a stock specific level. So we suspect that's the way to go. Now, in terms of themes, ideas we like, it hasn't changed. Over the last year plus, we've been very optimistic on agro and agro related, especially the agri input side. We like the healthcare space. We're beginning to selectively like some infrastructure names. So the themes have not changed. We've been very bottom up, and we continue to buy some of the ideas which we've identified earlier as we get them at better prices.
Right. The capital goods space, there's a fair bit of diversion which has happened both in terms of earnings, not so much in terms of prices, stock prices, because the dire space has underperformed. But I wanted you to talk about ABB and Siemens on the one hand, and probably Larsen and BHEL on the other. Both operate in the same spaces. Both are actually, all four are very large players, leaders in their own respective spaces, segments. But you think the quality of earnings is disappointed, much more as far as ABB and Siemens go, especially over the last couple of odd quarters. It's almost been about 3 or 4 odd quarters. Numbers have been pretty dismal.
Yeah, you're absolutely right. ABB, Siemens have been disappointments, and I mean, let's take them one at a time. ABB has always been an expensive stock, so there's really no room for error. And when the management comes out 2 consecutive quarters and disappoints, I think there's a case for probably derating it to an extent. Siemens, on the other hand, I think is decent, because relative to ABB, it's still more attractive. You have to put up with some kind of management, companies chopping and changing their ownership and different structures. So that's something You've got to just keep a track on. But my sense is that's the reason you're getting it substantially cheaper than ABB. Having said that, I think Larsen and Bale are probably better picks for a few reasons. Bale actually adds a lot of capacity, which goes live, and that will kick into earnings next year. So the problem of Bale not delivering, they have 5 and 6 years worth of order book, but execution still goes on at 25 and 30% a year. The hope is that now with the additional capacity coming in, their growth rate should begin to look up. Larsen is typically a project-based business, so they've had one, I think maybe even 2 disappointing quarters. But my sense is there's a lot of lumpiness in the way they book their revenues. And so it could all just come into one quarter. And therefore, the right way to look at Larsen is more on an annualized basis versus on a quarter-to-quarter basis. So of the 4, we would actually like Bale, Larsen, Siemens and ABB in that order.
Right. Telecom, there were hopes that earnings probably have bottomed out and all of that over the last 2 quarters, the fourth quarter and the third quarter as well. So margin probably have seen the bottom, earnings depression have seen the bottom. That might still be true, but we're hearing some astronomical figures as far as 3G auction prices are concerned. I think close to about 10,000 crores and more. You think it's going to do a lot more damage to stocks from here once the market gets a real hang of things?
Frankly, yeah, you're right on the first part, which is maybe the price wars are almost done. Stocks are available at 12-13 times, especially Bharti and Idea. So on that, the mainstream business things look okay, worth looking at these prices and at these valuations. But 3G is something, frankly, I'm still scratching my head trying to figure out how they're going to make money on these kind of bids. Maybe there's something we haven't picked up on. But yeah, it's hard to fathom the profitability based on the 3G numbers coming out right now.
Reliance and RNRL, Mohit, I know it's a blind spot, can go either ways, probably towards the latter part of the week. But how much importance would you give that event?
Not a whole lot. It's just going to be knee-jerk. The reaction might be for a day, at the most. But at the end of the day, it's only those 2 names that might get impacted. And of course, if Reliance gets impacted negatively, it takes the market with it. So to that extent, yes, Reliance getting an unfavorable verdict is important. But again, I just think it's going to be a knee-jerk reaction, nothing fundamental from the rest of the market standpoint. And that just goes back to our point, which is the markets might go nowhere, they might correct, but there are individual stock ideas that are still worth looking at. So Reliance, RNRL might be a knee-jerk reaction at best, in my opinion.
All right, fair enough, Mohit. We'll leave it at that. Great speaking with you. Thanks for taking out the time. Appreciate it as always here on NDTV Profit. That's Mohit Mirchandani at Taurus Mutual Fund outlining what he likes and does not in the current market environment. For bulls, it's been a slow and a sluggish start to the week, but then you got 4 more trading sessions left. Will they make up for the losses that the market faced today, or will probably we see a little bit more in terms of drawdown on prices? That's the question we'll try and answer. Thanks for watching this edition of Tips for Tomorrow. We'll be back tomorrow morning. Catch you at 8.